Welcome to Markets Now. I'm Michelle Rook along with Alan Brugler with Brugler Marketing. Well, we ended mostly higher over in the grain complex today, with the exception, I think, of Minneapolis wheat. Livestock futures a little bit more mixed. And Alan, thanks for joining us. Let's talk about soybeans first of all. A nice recovery considering we took out the August lows and some pretty key support early in the session today.
Yeah, I think we had a little downward momentum from last week. November beans lost 44 cents a bushel last week. That carried over into the overnight session, got into mid-morning and hit that technical objective, picked off some stops there. And then I think you got some of the spec traders in particular just starting to cover their shorts here. The market was still under some pressure from the strong U.S. dollar, but again, you've also got the grain stocks report coming up at the end of the month, and you're going to start to get a little position squaring going here.
Yeah, so do we hold this low until after the reports and then we start to see harvest pressure really come in and maybe move that market lower?
Well, harvest pressure is kind of a two-edged sword in that right now the funds need some sell paper from the commercials if they want to buy more. In other words, if they want to be bullish on these tight ending stocks or tight projected ending stocks for next year, they want to buy futures, but they need sell paper on the other side. And the biggest supplier of sell paper is the elevators when they take in beans from the farmers. So we really need more farmer selling here to generate that fund buying. The issue, of course, is we don't like the price level being below $13. Everybody's kind of bulled up on the future for beans and a kind of a reluctant seller. So mostly what you're getting right now is deliveries against forward contracts.
So what are you expecting in terms of the soybean balance sheet when we get to the quarterly stocks here on Friday?
Well, we've got it just slightly lower than what USDA used last month. The numbers are fairly well known for exports and for crush. The crush number is going to be a little lower than what USDA was using. Of course, we won't get the breakdown until the WASDE report in October. But the crush number was a little lower. NOPA told us that. So the wild card is the residual, seed and residual number. And, of course, that is a balance for crop production for last year. So if the residual gets too big, they'll adjust the last year's production. So, again, we're just going with about 5 million less than USDA, but there's a little slack there.
Corn ended higher with the help of the Mexican export business, but we also had a higher weekly close, just a slightly higher weekly close last week. But is it enough to say that maybe we've put in a harvest low, or are we trying to?
I think we're in a good position for a harvest low from several different technical aspects, both on the weekly and monthly chart and the daily charts in terms of being oversold and up against various levels of support. There is that one downside risk, which is the chart gap we left between September and December when September went off the board at a big discount. So, if there's bearish news out of Friday's reports, that may be the thing that breaks us that direction. If USDA tends to be a little on the bull side here, we may keep that open and it'll be a breakaway gap. I do like the seasonal timing for a bottom here in the next 3 or 4 weeks, and it could certainly be this early. But what we don't have is any earth-moving piece of fundamental data to get us going.
Yeah, and one of the pieces that would help us is if we could get more of this export business like we saw here from Mexico. Are we getting down to a price point where you think we're competitive enough we could start seeing exports continue to pick up or not?
I think we're now competitive. The FOB prices would suggest that we're starting to get competitive. That's been the issue in wheat as well. But this is the time of year when China and Mexico and Japan ought to be coming in and buying a bigger percentage of what they're going to buy from the U.S. China, as you know, has been very heavily invested in buying from Brazil after they approved the genetics out of Brazil tail end of last year, and because they're not particularly friendly to the U.S. right now. So they still need to buy some U.S. corn due to logistics and other things. And you're starting to see some Chinese shipments, but it's mostly corn that they had bought previously under unknown They're just switching the categories and loading it on a boat. So this is a price level that I think would be attractive to China and to South Korea and Japan and some of the other countries as well. But again, they're just waiting for that cheap harvest basis and availability before they ship.
What about quarterly stocks? A lot of times this report on corn is kind of a market mover. What do you anticipate?
Well, this one's a really difficult report to calculate on the grain stock simply because the fourth quarter feed and residual number is a mixture of old and new. The grain stocks number is only old crop inventory. But we start corn harvest in July on the Texas coastal bend and in August in some of those other Gulf states. So you get some of the usage that you had in August was actually new crop, and the old crop is still sitting there on September 1. So it's notoriously difficult to calculate. It also matters how much is on barges coming down the river to New Orleans and so forth. One argument for a smaller residual use this time is simply that the export program has been slow enough. There shouldn't be as much barge freight in this month's calculation. But we think slightly tighter numbers than what USDA was using. But again, that feed and residual can swing at 200 million either way.
Yeah. Not only do we have quarterly stocks, but we have the small grain summary, which may impact the wheat market. So talk about your expectations there before we talk about a little bit of today's action.
Well, the small grains report typically is not a major mover. It's they're making minor adjustments to yield. We think based on some of our condition models that SRW might have to come down a little bit. They might be a little high on their yield, but again, it's probably famous last words, 40 to 50 million max for change in production on that report. The big question will be, I think, on spring wheat, and if that comes down any further, given that Canada's had some production problems as well, there's a little more leverage there.
And what did you make of today's action? Because we had this spread trade, it looked like, going on with Chicago gaining on the other classes, but Kansas City, I think, hit new lows for the move before we did that. What's going on in that market right now?
Well, SRW has been trying to get as cheap as Russian offerings. Okay, Russia's been the low-cost provider. Actually, Ukraine's cheaper, but you can't get it because of the freight issues. There were rumors Russia had raised their unofficial price floor to $270 a ton, but nobody's really sure if that's true or not. We do know that they were too expensive on the Egypt tender last week, and only Romanian grain got sold. If that's true, then Chicago, which has been the one that's been trying to buy that market, trying to get sales in that market, if Russia really is enforcing that price floor, then Chicago ought to rally. HRW is still well above those other origins, French, U.S., Russian, the whole bit. So it's not going to be as affected as much by whatever the Russians are doing there.
Let's move over to the cattle market. Live cattle futures actually ended mixed, but off of session lows, as well as feeders, which were a little lower on the day. But, some of the early pressure, did that come from the cattle on feed report? Did you feel like we digested that well? And, is this a breather in a bigger bull market again?
Yeah, I think the market handled the cattle and feed report pretty well. It wasn't particularly bearish. There was a tendency to want to try and fade it there based on the placement numbers and so forth. But again, market held up pretty well. We've got some very short-term technical sell signals on the cattle, but we really couldn't break it on Friday or today. So I think that's we're a little nervous about a seasonal drop. Some deliveries perhaps of southern cattle against the board because the board's got a big premium to the south right now, that type of thing. But the market is still fundamentally in the up phase of the cattle cycle. We still don't have any expansion of the cow herd. Maybe in a couple of states we're starting to see a little heifer retention, but not. You're probably hard pressed to find that on a national number. And even there, that the initial retention phase typically means tighter feeder supplies and higher feeder prices. So again, we could see a $3 or $4 pullback here at some point simply because of seasonal factors, but the fundamental story is still bullish long term.
Right. And the cash trade, you know, steady just a little bit better last week. Do you expect that we're going to be higher again this week and maybe start continuing to pull the difference between cash and futures together?
Well, as we go into October delivery period, this is the last week of September, right? And options will expire a week from Friday on the cattle. Futures go clear to the end of October. So you should see some convergence over the next couple of weeks between the cash and the board. It seems like in recent delivery periods, it's been the South converging with the board. The North has tended to maintain a premium to the board and not allow too many deliveries there. So, you know, that's kind of our expectation here. The one thing that we're watching pretty closely, though, is the ready numbers, that is the number of cattle available to come out of the lot in October, are very similar to a year ago. And that's not been the case for most of this year. We've been under. So the packer has theoretically more leverage or less need relative to what they've had for the last couple of months compared to a year ago. Now, that said, cattle numbers are still down and overall supplies are still tight. But there is potential risk here if the consumers won't continue to pay up for the beef.
Yeah. And I want to end talking about macro markets because last week it looked like we were reacting to Fed Chairman Powell saying maybe we were going to stay higher a little bit longer than everybody expected on those interest rates. But now is the market this week kind of focused on if we have a government shutdown or not?
Well, I think that's coming up on the horizon here. You don't know if there's going to be a last minute deal. There were several proposals floating around at the end of the week to fund the USDA, for example, the ag budget, while leaving some of the other sections unresolved. So if those proposals actually get through and 3 or 4 of the main agencies, defense and so forth, get funded, it's going to be a really murky picture. If we get the whole government shutting down or the bulk of it, I think that does have some interesting aspects to it. One of which would be you get less supply of treasuries being offered because of the shutdown. Similar to what happened when we had the debt cap discussion a few months back. That could actually lower interest rates short term, although, as Moody's pointed out, these financial shenanigans ultimately hurt the credit rating in the United States.
Yeah, certainly something market is keeping an eye on, though, for sure. All right, thanks for joining us, Alan Brugler with Brugler Marketing. That's Markets Now.